Howdy, Jacob here. Today we're looking at Central Garden and Pet Company 164 of our generic stock screener. They're in the household products industry, 2.4 billion market cap on 3.2 billion enterprise value. Growth is over double in revenue over the last 10 years with a pretty abysmal return on invested capital. Gross margin relatively flat, operating margin relatively flat over the last 9 years or so. Nothing really to brag home about. A 6%, 7% operating margin isn't terribly impressive. Balance sheet has 489 million cash on hand with no short-term debt, but 1.2 billion long-term debt. Hasn't really gone down for the last 3 years. That long-term debt, let's say of about a billion, is their free cash flow has 328 million in the last year. Year before, negative 149. Let's say it averages about 200 million, and that is going to be about 5 years of their free cash flow to pay off that long-term debt. Not terribly concerning, as they do have, like I said, about 400 million cash on hand. So we're not terribly concerned about the balance sheet, but there's going to be a time where they will have to focus on debt reduction, and it looks like they haven't focused on it at all for the last 10 years. Everything is based, not everything, but in balance sheet perspective, you base the risk level on a ratio. And what I like to do is base it on free cash flow. Free cash flow, money in, money out, not much to fondle with, not much to jazz around with. It's really just going to be, your cash in, cash out. And so if they can increase their free cash flow, double it, and they don't increase their debt, the ratio goes down to 2.5 years. So, I mean, it's not all said and it's not 100%, the way it is, but I do like to focus on debt reduction given the fact that cash flow growth isn't guaranteed. But anyways, I think we're ready to make some assumptions here. I think on the revenue growth side, it has grown pretty substantially. There has been some acquisitions along the way. Looks like a few net acquisitions and then one large one in 2021. And since then, not a terrible amount of growth. So maybe let's go with 5%. Let's do 13 PE and free cash flow based on the fact that their enterprise value is quite a bit higher than their market cap. A margin on the net income side of, let's maybe do 5%, 6% with share change. They have been buying back shares, but really just offsetting stock-based compensation here. So capital allocation is pretty interesting in the last couple of years. It looks like majority of their free cash flow is just going towards acquisitions, not a substantial amount going towards share repurchases here. And so basically with my assumptions, if we want to get 1% share repurchases, you're looking at about 24 million, about 50 million for stock-based compensation. I think that is reasonable. So let's put that in. It's about 25% of free cash flow. Let's say they use about another 25% for debt reduction, leaving about 50% to acquisitions. And if they have 50% capital allocation to acquisitions, I think revenue growth of 6% is pretty reasonable to me. So again, with these assumptions, we're saying the company's stock price needs to fall 39% before you get the return we're looking for here. Not terribly far off, but again, I don't usually like to look at companies and do an in-depth analysis until it's obviously cheap, and I just don't think we're there at this moment. So I'll just be reviewing other companies. Hope you enjoy the video and have a great day. Thank you.